Hi friends, I am your Joel John. Now I am going to talk about types of hybrid funds. Let's quickly get into the topic. Hybrid. This is going to be the part 1C of our mutual fund videos. An hybrid fund invests in a combination of equity, debt, and gold. The risk and return depends upon the allocation of asset classes between the equity, debt, and gold, and the type of securities in which they are included in the portfolio. So the equities or long-term debt compounds invest in low rate investments will lead to high risk. So this is a high risky fund, but there is kind of allocation percentage. In some funds, what they do is the fund manager has the role to change the allocation percentage. Those decisions will be taken by the fund manager, and you have to look at the scheme document carefully. So this is much better than direct equity, that I can say, and also has a chance to give you better returns. So now we have debt oriented hybrid funds which invest mainly on debt and a small allocation in equity. The equity allocation will range from 5 to 30% as stated in the offer document. Debt components to earn coupon income, and equity to boost up returns through the capital appreciation and the dividend yields. And then you have the monthly income debt funds, a debt oriented hybrid fund to declare a dividend every month. Still there is no guarantee for the monthly dividend to be declared. So these are something which we call it as monthly income planners for person who need, mostly for pensioners or persons who don't have other income, who feels that we can invest something and get income. Check whether it's a guaranteed income or not. Most of the funds don't really have guaranteed income kind of thing. Okay, and then we are going to look at the multi-yield funds. Invest in multi-apple asset classes such as equity and debt. It generates returns over medium term. Balance fund is a popular equity oriented hybrid fund. Its scheme objective is to provide growth equity and stability through debt funds. Information about the allocation of investment style is furnished on SID, scheme information document. So this is a very important thing to read. This is where you have the most of the scheme related information. And another things to note are SID, SAI and KIM are important documents which we will discuss on the later videos. And to talk and to give the full form, SAI stands for Statement of Additional Information, and KIM gives KIM stands for Key Information Memorandum. So SID, SAI and KIM are those which you have to carefully read on the mutual fund scheme, okay, document. Then we have the Capital Protect Scheme. Capital Protect Scheme are closed-ended funds which are structured to ensure that the investor gets their capital back. This is done by investing on zero coupon government securities whose maturity is in line with that of the scheme. So zero coupon securities I will explain a little bit, then you can understand this easily. So zero coupon securities do not pay regular interest, but accumulates the interest and pay it with the principal at the when the security matures. In capital protect schemes, the purchase of zero coupon securities whose maturity amount equals to the principal of investments in the scheme. The leftover interest equated money is invested on high risk securities to equate to like equity to give some higher returns. So capital protect schemes can be viewed as capital protection oriented scheme, as any borrower other than the government can default. So capital protection can also offer through a guarantor from a guarantee from a guarantor who has financial strength to offer a guarantee, but availability in market of such things are very less. So I will explain about this capital protection scheme for those who are a little bit confused with this. The thing is that they will say some kind of investment money, right? That money they will look for a government zero coupon bond. Zero coupon bond is something only at the end of the scheme you will get coupon period, that's the security lock-in period, you will get the money back, the principal plus the interest accumulated. Okay, so the accumulation value, that's the final value they will calculate. That will be your maturity value mentioned, which is the guaranteed maturity value, and the remaining part is left over, right? So the interest part which accumulates minus the total maturity value, total maturity value minus the fund you invest will give you the interest part. That interest part they invest on high risk funds like equity to give you more returns if possible. Even if you lost that, your money is back. So that kind of investment option is this. And the another one thing is asset allocation fund. The fund manager decides the allocation of assets based on the expected performance. These funds do not specify a minimum or maximum limit of asset allocation. So this is something, the allocation is completely decided by the fund manager. So fund manager has a very vital role playing on this. So the fund manager experience is to the key parameter to decide to invest on the fund. So we have the arbitrage funds which takes position in different markets and securities, thereby neutralizing the risk, but returns are earned. To tell short about this, what they do is you have a different kind of stock exchange like the NSE and BSE. So when the price is of a same equity is less in NSE, I will buy it, and simultaneously I will see that BSE the price is high. So I will buy in NSE and sell in BSE, thereby getting some gain. Mostly they do this with the combining with the futures and options. That's where they get the better return. The arbitrage funds take contrary position between the equity market and futures and option market. Futures and options are commonly referred as derivatives. So this also you have to know. Now we are getting into the real estate sector. Okay, so we get into the real estate mutual fund scheme. First we have the real estate trust. Okay, so the real estate mutual fund scheme invests directly or indirectly in real estate assets and other permissible assets as per the regulation of SEBI Mutual Fund Regulation 1996. So the regulations are given on SEBI Mutual Fund Regulation 1996. So we will look at few of them. At least 35% of the portfolio should be held in physical asset, not less than 75% of the net asset of the scheme invested in real estate assets, mortgage-based securities, but not directly on mortgages. Equities like shares and debentures of companies engaged in dealing in real estate assets or in underlying real estate development projects. In this, the 75% or above of the scheme fund should be invested. The assets held by the fund are validated in 90 days by two validators aggregated by the credit rater agency. The lower of the two values is taken for calculating the NAV. These are closed-ended funds, hence listed in stock exchange. I think there are a lot of words in this. So through this paragraph, please go again and be careful. And then we have the real estate trust. These are registered with SEBI as trust that invest in commercial real estate assets, raise funds through initial offering, value of assets owned or proposed to be owned by REIT, that is the real estate investment trust, coming from an initial offering will not be less than 500 crores. The minimal offer size should not be less than 250 crores, and the minimum subscription amount of an initial offering shall be 2 lakhs. Subsequent follow-on offers, right issues and institutional placement can be used to raise funds by REITs. Units will be listed on stock exchange. So these are something about the real estate investment trust. And then we will be going into the commodity fund. Commodity fund invests in commodities. Investment's objective states the asset classes of commodities in which they invest. So in a commodity fund you will have something called as the asset classes. So what are asset classes? We will see some examples through which you can understand that. So these are asset classes of commodity, not general asset class. That also we have to know about that. So if they say food crop, it will be like wheat, barley, sugar or pulses. Spices we know pepper, turmeric, that kind of things. Fibers we have jute, cotton and etc. Industrial metals we have bauxite, aluminium, nickel, cobalt, copper, etc. Energy products we have petroleum, which will everybody will know. Oil and natural gas are also there. Precious metals like platinum, gold and silver. So these are the types of commodities which they invest. And now we will be looking into some of the specific ones. For example, first we will be looking into the gold fund. Gold funds invest in gold and related securities. The first thing is that gold exchange traded fund is like an index fund investing in gold. Each units represent 1 gram of physical gold, which is of 99.5% purity, and or gold receipts also they can invest. So a lot of one words here. Can invest up to 20% in gold deposit schemes of banks. NAV moves in line with the market price of gold. These are the key features of gold exchange traded funds. Then we have gold funds which invest in units of gold funds and operates like any other mutual fund. The gold fund operates. So then we have the gold sector funds. These invest on shares of companies which are engaged in the mining and processing of golds. NAV depends on the portfolio of the invested company, its gold reserves, and also gold price also plays a small role on that. Okay. Note that gold exchange traded funds are commodity ETFs and gold sector funds are commodity sector funds. So there is a difference between the commodity ETF and commodity sector fund. A kind of a commodity sector fund is a kind of a equity fund. That also we have to know. So again, very huge densely one words are there in this. So we have international fund. International fund invest in markets outside India holding foreign securities in their portfolio. They can also invest in Indian equity and debt and money market instruments for managing their liquidity needs. In alternative routes, it's tie-ups with the foreign fund. The foreign fund will be called as the host fund. The foreign fund is called as the host fund, and the India it will launch a fund called as federal fund. The fund which is launched in India is being called as the federal fund. International fund invest. So in this I will explain. So when we invest on international fund, the investor money is being collected on Indian rupee. It's going to be converted into a foreign currency. So at that time the currency market pricing is there. Then when you redeem the unit, the price difference between the Indian rupee and the foreign currency is there. So currency fluctuation also plays a role on this. So be careful about that also when you are going to invest on this kind of international funds. Then we have the fund of funds. This invest on other mutual funds. It do not hold securities but hold other funds, debt or equity chosen matching the investment objective. The investing fund may hold maybe of the same investing mutual fund company or of a different company. They can invest on funds of their own company or on other funds as well. These are called as FOFs, fund of funds. Belongs to various mutual fund houses or called as multi-managed FOFs. FOFs have expense of all funds added up, which reduce the NAV value. So already the funds which we add, they would have reduced the expense of that fund, and they would be giving a NAV. We are going to invest on that. We also have expenses. So two times the expense is calculated. So this is a disadvantage in this fund. And then we have the exchange traded funds. And again, these exchange traded funds have lots of things to know. So be careful, and it's not high risky, but still equity part is there, so it's risky with high returns, and too many questions and terminologies are there. That's something we have to get into. So I will talk about this. Exchange traded funds are open-ended funds whose units are traded in stock exchange. Investor can buy units from mutual fund during NFO. Further purchase and sales transactions are done on stock exchange where the units are listed. The mutual fund issues further units and redeem it directly only in a large lots defined as creation units. So the mutual fund also does redeem, and they also purchase the units directly, which is called as creation of units. In order to facilitate these kinds of transaction in stock exchange, the market determined price, mutual fund appoints intermediaries called as authorized dealers, and these people are called as market makers, whose job is to offer a price quote for buying and selling units at all times. During high demands, these market makers appointed by the mutual fund release units from the mutual fund, which is called as creation of units. They also reduce the units in the market by getting units redeemed in creation of units. So this is the role of them. Thus market makers provide liquidity in the units of ETFs to investors. The advantage of ETF is unlike regular open-ended mutual funds where the purchase and sales of units happen in single price in a day. ETFs units are bought and sold on stock exchange, which is mostly same as NAV value, but not, we can say, assured. Unique structure of ETFs makes it cost effective than normal index fund. So it has unique features so that it's a cost effective fund than other index funds. And also we have to note that there is brokerage charges if we do the transaction to market makers, and also we should have a demat account where which is required for the units of ETFs to be credited. Then we have the infrastructure debt scheme. Infrastructure debt scheme are closed-end schemes with tenure at least 5 years, investing in debt securities and securitized debts of infrastructure company. 90% of the fund should be in specified securities, 10% can be in equity of again infrastructure companies and also money market instruments. NAV to be disclosed at least once in each quarter. Minimum investment allowed in this scheme is 1 crore. The minimum face value of each unit is 10 lakhs. Listed on a stock exchange, sponsor and key personnel must have adequate experience in infrastructure sector to launch this scheme. So these are some of the main features. And then we have the Infrastructure Investment Trust, INVIT is a short form. These are also registered with SEBI, investing in infrastructure, raising funds from public through initial offering of units, which should not be less than 250 crores. The value of the proposed asset should not be less than 500 crores. The minimum subscription size will be 10 lakhs and units are to be listed on the stock exchange. So now we have seen about the mutual fund types and all those. So now let's look at the some of the key developments over the years in mutual funds. In late 80s, public sector mutual funds were first permitted, and in the mid of 90s, private mutual funds are also commenced operationing. The factors driving the mutual fund growth are in stock exchange brokers are being provided as an additional channel, so that booms the growth. And we also have technological development where we can trade using laptop, mobiles, blah blah blah, so many things, calling call center. And financial literacy is also high, so people are aware of inflation, they know about other types of investments, market related investments, so those kinds of things. But still, watch a lot more, learn a lot more, knowledge has to be gained. You have to speak and about these kinds of topics, so that we can create a meaningful society. And then we are going to talk about the asset under management in the AUM in the mutual fund companies. The records are as on January 2017. We have touched about 17,37,087 crores from 2,244 schemes offered by 41 mutual funds. Still, if we compare with the global level, our AUM, that's asset under management, is not even accounting for 1% of the global. And US with the 40 trillion AUM, asset under management, accounts for the 39% of the global mutual fund holdings. So by this I come to the end of the video, and also I'm going to talk more about mutual funds. I am also going to talk about other topics. With this, part 1C is also over and part 1 is also over, and think this will be useful for you. And to talk more about this, I will be going through, I have to go through a lot of preparation, and I think I have rushed up on this video. I'm really sorry for that, but I have no other way to finish this video within time. And also with this, the concept and role of mutual funds, the chapter 1 is, that's part 1 is coming to an over. So I think I may cut short all the key points and given to you. For NISM preparing people, it will be, I believe that will be useful. Subscribe to my channel. Still I have to post about some 10 parts, and abbreviations I have created a video, so check for that in my channel and see that. That will give you a clear idea when we use short forms, abbreviations, which are commonly used on newspapers and everything. And also in users, they most of the time they don't use the full form, they just go with abbreviations, so that you won't understand that. So go through that. After that, your financial knowledge and understanding capability will increase. So now it's time to sign off. It's your Joel John J signing off from you. Bye.